Good evening, everyone. Today is March 3rd. Let's review how the three major U.S. indices performed and discuss what could come next. Today's session was highly volatile. The backdrop is clear: escalating Middle East tensions. As we mentioned yesterday, the conflict itself is not the core issue for markets. The real risk is whether the Strait of Hormuz could be closed. If that were to happen, the chain reaction is straightforward and potentially severe for the U.S. economy. We discussed that a disruption in the Strait of Hormuz could send crude oil, natural gas, and broader energy prices up 30% or more. If energy spikes like that, it would push already elevated PPI and inflation metrics even higher. Right now, the United States is operating with very high debt levels. At the same time, a large portion of capital and liquidity is concentrated in the AI theme, a theme that some investors increasingly worry could eventually face a bubble risk. As a result, economic momentum is not broad-based. It's not a healthy multi-sector expansion. Instead, growth and capital flows are concentrated in a narrow group, mainly technology and energy stocks. And both of these sectors are now facing potential bubble concerns, or at least rising uncertainty about their future sustainability. For example, take Nvidia. The stock declined about 1.3% today. We've previously discussed how strong and impressive its latest earnings were. Yet even with those strong results, the market did not respond positively. That tells us something important. When you layer rising energy prices on top of already elevated inflation, add historically high debt levels, and then consider that the market's primary investment narrative may be nearing exhaustion, the result is growing concern about stagflation. Stagflation is one of the most difficult macro environments for investors. The last major U.S. episode was in the 1970s. Back then, aggressive tightening under Paul Volcker eventually broke inflation and paved the way for a multi-decade bull market. But today's setup is very different. Today, overall debt levels across the economy are significantly higher. That alone limits policy flexibility. In addition, the incoming Federal Reserve leadership is widely perceived to be more closely aligned with the Republican administration. In that kind of political environment, the likelihood of implementing highly aggressive, unconventional shock therapy style tightening to forcefully reset the system appears much lower. In other words, the type of drastic intervention that was used decades ago to eliminate stagflation may not be as feasible under current conditions. So this stagflation overhang for traders and for all investors is a super nightmare. How serious is stagflation? If you're not familiar with it, I'll dedicate a separate episode next time to explain just how damaging stagflation can be. Therefore, if the war continues, if the Strait of Hormuz remains at risk of closure, and if oil prices keep surging, the impact on U.S. inflation would be extremely significant. In that case, the interest rate tools and policy tools available would become very limited. In this situation, the market starts moving into risk-off mode today, right? Including what we just mentioned. For example, Nvidia. It's one of the core stocks in the market and also the largest by market cap. You can clearly see funds continuously pulling out. In fact, capital started flowing out as early as the past 2 days. You can see it in the volume. Starting the day before yesterday, we saw a gap down, a lower open, and then price consolidating at the lows. What does that tell us? That gap already signals something. The market has begun rotating out of high growth stocks. As everyone knows, during inflationary periods, the market generally shifts toward a defensive stance. The overall allocation reflects that too. Today we saw U.S. Treasury yields surging again. The U.S. dollar is also rallying sharply on strong safe haven demand. The entire market is filled with risk-off sentiment. The volatility index is spiking as well. This is exactly what we warned about many days ago, even before the conflict began. We said the alarm was sounding. At a time like this, you have two choices. First, cash is king. You must preserve your cash position. With the dollar surging and Treasury yields rising, holding cash is potentially a safer choice than staying in high growth stocks. Second, allocate into defensive stocks. What are defensive stocks? Think about basic necessities: clothing, food, housing, transportation. Remember that. Broadly speaking, investments in the virtual economy, cutting-edge tech sectors, even the basket of names that surged yesterday, those are all about buying the future. But right now you don't buy the future. Right now you buy essentials, things around you, everyday necessities, because those are the assets that can truly provide protection during an inflation cycle, especially in a stagflation environment, which is even more dangerous. In a moment, we'll recommend a defensive stock to everyone. All right, let's move back to the technical analysis. Back to the NASDAQ. Among the three major indices, the NASDAQ is essentially the barometer. During the consolidation at the highs, it was the first to show signs of weakness. Back in October last year, during that 3 consecutive gap-up move, it was also the first to display relative strength. And now again, it's the first to show deterioration. Previously, we divided the high-level consolidation into 3 equal sections. Now it has already moved back into the weak zone. Just yesterday, we were asking whether it would return to the weak range. My answer yesterday was still a level 5 alert, and there was a possibility it would fall back into the weak zone. Today, although the close looked like it recovered from an extremely panic-driven sell-off, don't just look at the result. On the 1 hour chart, did you notice? From the hourly perspective into the late session, it was already starting to lose momentum. It couldn't hold up. It was beginning to struggle to stay elevated. As for this late session move, I believe the intraday volatility was driven by news flow. But the impact of news on intraday price action will usually be digested after hours or the next day, and then price tends to continue along its original path. Why was there panic at the open today? Because Iran said that vessels should avoid the Strait of Hormuz, essentially a threat, right? Then the market started selling off sharply during the session. There was clear panic because that development could potentially push up domestic energy prices in the US, which in turn could further fuel inflation. So what happened next? President Trump posted a tweet saying that the US would provide protection for all ships passing through the strait, but they would have to pay for it. He even mentioned deploying the Navy to ensure energy flows globally. That stimulus came at a very timely moment, around midday. After the tweet was released, the market began a round of adjustment, a structural adjustment. Capital started rotating, shifting from defensive positioning back toward a more offensive stance. But into the late session, you could see divergence beginning to widen. So after cutting through all the noise, here's the conclusion. That late session push already showed slight weakness. There were signs of exhaustion. If nothing unexpected happens, tomorrow's open is likely to continue lower. Looking at after-hours trading, the Nasdaq's performance is exactly as I mentioned. The market may already be starting to lean defensive again. Capital is beginning to rotate once more. All right, today it's rare that we specifically talk about the S&P, which previously had very healthy price action and structure. But today, the S&P broke a very, very important support level. It broke the low of that specific day. What was the low of that day? 67.20. Today's low came in at 67.10. Although it's only a 10-point difference, the symbolic meaning is extremely significant. If we turn on the moving averages, the MA lines, you'll see that price has completely broken below the entire bullish alignment. Completely broken below the bullish alignment. All the candlesticks, including today's close, failed to close back above the bullish moving average structure, and the bullish alignment itself has already begun to show dislocation. This is very, I wouldn't say frightening, but it is an extremely important signal. The original alignment has been damaged. If we look back to November last year, there was a stretch of about 10 consecutive down days. Even then, price only stayed below the moving averages for 1 to 2 days before quickly reclaiming them, and the bullish alignment was not destroyed. But this time, after a narrow consolidation at high levels, the bullish alignment has already been broken. So what's the conclusion? It's very dangerous. If the S&P is in danger, that's even more significant than the Nasdaq being in danger, and even more than the Dow being in danger. Why? Because the S&P represents the backbone of the American middle class, the core strength. It reflects rational investors and carefully selected stocks. It's not like the Dow, which is simply an industrial average. It's not like the Nasdaq, which is dominated by technology and high-growth names, where investors chase high profits. The S&P symbolizes rationality. It represents a more neutral, balanced view of the market. And now the S&P 500 is in a very dangerous position. Very dangerous. Let me emphasize that again. Here's the key. If within the next 1 to 2 weeks, it cannot quickly reclaim the 150-day moving average, I've marked 144 here, but you can adjust it to 150 or keep it at 144 like I do. If it cannot reclaim and hold above that 150-day line, then the situation becomes extremely dangerous. So today's focus is still to warn everyone about risk. In this environment, I have several suggestions. First, reduce exposure to high-growth AI stocks. I'm not telling you to liquidate completely, not to sell everything, but to trim your allocation, lower your exposure. That's the first point. Second, rotate toward cash and defensive stocks. What are defensive stocks? As I mentioned earlier, necessities, especially food-related names. Today, I'm recommending Cal-Maine Foods, Calm. We've talked about this stock before, but we didn't strongly recommend it at that time because the scale and duration of the conflict and its economic impact were not yet clear. At that time, we thought it might resemble a limited strike like a decapitation-style operation that ends quickly happened in Venezuela. But now it appears to be a large-scale military action, and it's unlikely to end as quickly as the White House suggested. This involves the broader Middle East and the global geopolitical structure. It's not something that can be resolved rapidly. So, pushing U.S. inflation higher becomes very possible. Under these circumstances, inflation risk could easily intensify again. Why recommend Cal-Maine Foods? Its business model is simple. It produces eggs. Very straightforward. Everyone needs to eat. Everyone consumes eggs, rice, grains. Food demand is non-negotiable. Its earnings report is very strong. I won't go into all the details, but the numbers look good. The valuation is reasonable. The PE ratio is appropriate. From a technical perspective, looking at the daily chart, after a pullback, this level should have broken down, But it didn't. After a brief false break to the downside, price quickly reclaimed the prior consolidation range. That consolidation range is very important. What does that mean? With the war backdrop combined with strong earnings, the market has re-rated its value. Technically, this has formed a classic inverse head and shoulders pattern, or you can call it a composite bottom. In that case, focus on the neckline. The neckline level is 89.38. Once price breaks above that level, you can initiate a position. You don't even have to wait for a pullback. Establish a starter position first, then reassess. This is the first defensive stock I'm recommending. There are two other categories, one related to crude oil, one related to mining. But today we'll focus on food, which has a high probability of outperforming in an inflationary cycle. This is not investment advice, but it provides a framework for thinking. At this stage, we need to be more cautious toward high-tech names, AI-related stocks, and market darlings. Why? Because when valuation compression happens, they fall the hardest. In inflation cycles, capital flows out of high-growth technology stocks the most aggressively. So today's message is important. We're in an era of dramatic change, an AI-driven transformation unprecedented in human history, combined with intense geopolitical conflict. This is a time that tests investors' patience and discipline. We'll continue sharing new observations and market insights daily. That's all for today. We'll see you tomorrow.